Welcome to our deep dive on understanding and optimizing tax implications through cost basis and share sales. We will discuss strategies for minimizing your capital gains tax, particularly as it pertains to the sale of stocks, including the intricacies of fractional shares and automatic dividend reinvestment. Let's take a look at what we'll be covering in today's video. We'll start with understanding the concept of cost basis. Then we'll discuss different methods, like FIFO, when selling shares, and the process of identifying specific shares for sale. We'll also touch upon fractional shares and dividends, strategies to minimize capital gains tax, the implications of short-term versus long-term holdings, and emphasize the importance of seeking professional advice. Let's start by understanding what the cost basis is. Your cost basis is essentially the original value of an asset at the time of purchase. This value includes all costs like commissions and fees. When you eventually sell this asset, your profit or loss is calculated by subtracting your cost basis from the sale price. It's a fundamental concept, crucial for determining your capital gains or losses. The first in, first out, or FIFO method is typically the default setting in most brokerage accounts. This method considers shares you bought first as sold first, meaning your earliest stock purchases are the ones considered sold when you make a transaction. Importantly, your earliest purchases might have a lower cost basis, which could ultimately result in a higher capital gains tax when you sell. When it comes to actually selling stocks, identifying which shares to sell can be an option if your brokerage allows it. If not, shares are usually sold on a FIFO basis by default. It's important to pay attention to your Form 1099-B, which will report details of your sales at the end of the tax year, outlining which shares were considered sold. Fractional shares do not fundamentally change how cost basis is calculated. Each fractional share has a cost basis equivalent to the percentage of its full share. Reinvested dividends add to this cost basis, increasing your total costs, which could potentially reduce your future capital gains, offering a sort of tax benefit. There are several strategies to minimize capital gains tax. You might consider selling shares with a higher cost basis strategically, or spreading out sales over multiple years to keep gains within lower tax brackets. For personalized advice tailored to your financial situation, consulting a qualified financial advisor is highly recommended. Here's a quick quiz for you. What is the main benefit of holding an asset for over a year? Is it A, higher cost basis, B, lower long-term capital gains tax, C, more dividends, or D, higher short-term capital gains tax? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is lower long-term capital gains tax. When you hold an asset for over a year, you qualify for long-term capital gains tax rates, which are typically lower than short-term rates. One of the essential tax implications to consider is the difference between short-term and long-term capital gains tax. Generally, short-term capital gains for assets held for less than a year are taxed at a higher rate. By holding assets for more than a year, you can benefit from lower long-term capital gains tax rates. It's always prudent to consult with a qualified tax advisor or financial planner. Navigating tax laws can be complex, and professional guidance ensures you stay compliant while planning effectively for tax optimization. Thank you for watching our video on understanding cost basis and share sales for tax optimization. If you found this video helpful, please like, share, and subscribe to our channel for more informative content. Also, feel free to share your thoughts in the comment section below.